Welcome to Market Week in Review for the week ending September 27th, 2024. I'm Sophie Antal-Gibert, and I'm joined today by our Chief Investment Strategist for North America, Paul Eidelman. Paul, it's a pleasure to see you. How are you?
Yeah, I'm doing well. How are you?
Very good, thank you. So I'm thrilled to be in the studio with you because there has been a lot of news and a lot going on, and I'm hoping that you can help us clarify a little bit of what is the news and what is the noise.
Yeah, sure thing.
So two topics in particular. One is around Chinese equities, which have rallied, and the second one is around what is happening with the U.S. treasuries. Can we start with Chinese equities first?
Yeah.
All right, so they have rallied significantly recently. What is leading to that, and what are you seeing in that news?
Yeah, it's been an enormous move this week. MSCI China, week to date through Thursday's close here in Seattle, is up 17%, if you can believe it, in just a few days. And obviously that's markedly outpacing the global equity market. Behind that, Chinese authorities have been moving towards providing a little bit more stimulus into the economy here over the last few sessions. In terms of the details of that, they had a surprise Politburo meeting here in September, and on the back of that, they announced a couple of things. We don't have a lot of detail around it, but they put out an explicit statement that they intend to stop the decline in the housing market. That's a major engine of growth for the Chinese economy and an important statement there. Also noting that they intend to make fiscal policy, broadly speaking, more supportive for growth going forward. And so obviously our specialists in the regions want to get more of the details to figure out exactly the economic impacts, but certainly from a signaling perspective, good news here that China is starting to step in and provide support for their economy, which has been ailing for the better part of the last 2 years. And then in terms of actual steps and actions, the People's Bank of China, the central bank in China, did cut rates and reserve requirements this week. And importantly as well, they've put in place some tools through the banks to try to incentivize them to buy into the equity market and boost sentiment for shares. So it's been a really dramatic move in Chinese assets this week. And I think a useful reminder that sometimes less bad can be really good from a financial market perspective. China's been an unloved area of the market for a couple of years now. It's been trading on a single-digit forward PE multiple, and so on the back of this incrementally positive news, obviously a really big move in Chinese financial markets on the back of it.
So you mentioned the PBOC cut interest rates recently. They're not the only ones. Obviously, the Fed did that in the U.S. last week, off of which we would have expected Treasury yields to fall, and instead they've now risen. Can you help us understand? Fixed income is complicated and always seems to work backwards, but now it seems to be working backwards of what we would have expected.
Yeah.
What's behind that?
Well, it's a counterintuitive move. So even though the Fed cut rates by 50 basis points, what we've seen subsequent to that is actually the U.S. macro data at large showing some resilience for the economy and the outlook going forward. And there's a number of data points, but I think amongst the most important of them has been initial jobless claims. We just got the latest batch of those figures this morning on Thursday in Seattle, and jobless claims fell pretty notably. They positively surprised. And so in the U.S. economy, in the labor market, while there's been some slowing, importantly, we're still not really seeing any signs of a layoff cycle, which is really important for sustaining the economy and the consumer going forward. And so I think it's that positive news and signs of resilience in the labor market, which has been an open question for a lot of investors, that's causing investors to say, hey, well, okay, the Fed cut rates by 50 basis points, but maybe they won't actually sustain cuts at that magnitude going forward. And so a little bit of a repricing of the forward curve, bumping up long-term yields on the back of that resilience.
Excellent. That is helpful. So this week, the Treasury yield sort of befuddled us and surprised.
Yeah.
What might surprise us next week? What is your crystal ball, or what are you focused on next week?
Yeah, I think the labor market is still a really important watch point here around whether the U.S. is headed towards a soft landing or a hard landing. And next week, we have the key U.S. employment report for the month of September. The consensus is pretty positive around those figures, thinking we could have non-farm payrolls growth of around 140,000, which would be pretty decent, and a stable unemployment rate. If the numbers come in line with those consensus expectations, I think that would be welcomed by financial markets. But if there is a disappointment, the market has shown more volatility and sensitivity to those kinds of moves in recent weeks. And so I think any surprises there will be a key focus for investors in the week ahead.
Terrific. Well, we will look forward to hearing from you again next week. Unfortunately, this is all we have time for this week, but thank you so much for your insights, Paul.
Yeah, thanks.
And thank you for joining us. We'll be back again soon.
Hi, I'm Sophie Antel-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.